I'm Justin, originally from Fundera, and this is Duncan from COVID Loan Tracker, and we've teamed up to bring you a webinar here today on PPP, specifically the PPP program forgiveness. Now that a lot of businesses have received funding and are looking forward to getting those loans forgiven and turned into grants. I'm going to start the webinar here by walking through some slides that summarize forgiveness, and then Duncan and I are going to chat a bit about, some hot kind of, more topical questions that people have kind of sent in beforehand or we've received in other webinars, and try to answer the most pressing questions around PPP forgiveness. Like the application process, when you first receive your loan, there's a lot of nuance to it. There's a lot of guidance from the SBA. Some of it's not always crystal clear, and there's probably things that will continue to be clarified. So we're gonna jump right in here, give you a little bit more background on COVID Loan Tracker and Fundera, and I'm going to show a few slides, and then I'm going to take the slides down midway through maybe and bounce back into Q&A with Duncan.
Sounds good.
So I'm going to put up Duncan. I'm going to throw up these intro slides real quick. You can kind of give a little background on COVID Loan Tracker, and I'll do the same for Fundera.
Sure.
Okay. So I'll let you go first.
Sure. So I think most of you know who we are because it's part of the webinar, but basically my wife and I, Rita, founded COVID Loan Tracker beginning of April because we were really frustrated with not having any idea where our PPP loans were. And so we put up a crowdsourced site, and that's led to a number of things. So we're providing data. We have a lot of information on PPP and IDLES and where they went. We're providing now a lot of resources, advice, and information about how to get through this funding landscape, how to position yourself for PPP forgiveness, which is obviously what we're discussing today. And then we're also quite big on the advocacy front. So we're in touch with the SBA, we're pushing policymakers, we're providing data to try and get rules updated and adapted to be more small business friendly, which we're kind of hopefully starting to see with the new House package.
Awesome, thanks. So I'm gonna, like I said, I'm Justin from Fundera. Fundera is a marketplace for small business financial solutions. We've in the past, kind of pre-PPP, mostly helped small businesses get funding through lines of credit or short-term or medium-term loans, also SBA 7A program loans. We also have, a large amount of educational resources on our blog and website around educating small businesses on all sorts of different topics, and also review things like business software, credit cards, bank accounts, so on and so forth. So we then, also have kind of, acted as an agent during PPP and helped facilitate thousands of small business PPP loans through our various lending providers. So with that as the backdrop, I'm just going to hop in and give a quick summary of the PPP, a summary of PPP forgiveness, actually. So I'm going to start by, kind of some recent developments. So, when the program was instituted, it was always envisioned that for a large percentage of borrowers, this would be a forgivable loan, meaning it would turn into a grant. And a couple of weeks ago, the SBA finally released the application, which you can use to apply then to your bank to receive this forgiveness. There's a few main stipulations that concerned how the money is spent and how your headcount and pay levels match up to kind of covered period levels. And there's a lot of math that goes in this application, and all to say that it's slightly confusing, and hopefully, if you do it correctly, you can get most or all of your PPP loan turned into a grant. On May 22nd, the SBA released some additional guidance. These two kind of links in this presentation, which I believe we're going to share, kind of point you to the right SBA documents. These are kind of the Bible for how to interpret this. As forewarning, it's not easy to interpret, which is why, one of the reasons we're doing this webinar here today. So this is kind of what I just covered. Essentially how this works is, you've gotten your loan, it's in your bank account, you're spending it. You need to spend a certain amount on different types of expenses, most of those being payroll. You have an 8-week period to spend, the PPP funds, and you'll be judged on how you spend it. And like I said, those employee, potential reductions factor in as well, but that kind of impacts what you'll end up being forgiven at the end of the period. So the first, question we get a lot there, the first basis of PPP is, what is my covered period? What is my 8-week period? And how do I know, what falls within that period? So, at first this was, okay, it's 8 weeks. As soon as I get my money in my bank account, it's 8 weeks from that day. Well, it's actually 56 days, not, if you got your loan on May 5th, your period doesn't end on July 5th. It'll actually be a few days before that. I don't have the calendar in front of me, but it'd be 56 days. But now the SBA has even introduced something, a little easier in the form of this alternative payroll covered period. This is important as I think it generally simplifies this process for most small business owners. It basically says that if you pay, your payroll every 2 weeks or more frequently, as in weekly, then you can start your covered period on your next payroll start or your next payroll period start date. So if I received a loan on May 10th and my next payroll is paid out on May 15th, I could start my covered period on May 16th, meaning that then if I'm paying every 2 weeks, essentially I'll have 4 payrolls cleanly run during the covered period. And that's a lot easier to calculate, than if you're trying to take 5 days from the previous payroll and then 10 days at the end of the cycle. So that's kind of how this works. It's a 56-day period. You can choose one of 2 ways to start that clock. I'll cover this, sort of at the end, but this is something, this 8 weeks is something that will potentially get changed by current legislation being evaluated.
Hey, Justin, just a quick question about that for the community.
Yeah,
is
sure.
If you're doing the covered period, not the alternative covered period, what is day 1 of the loan? Is it the day you receive it? Is it the day following? This is a question some people have, so they know when exactly something starts and ends.
Yeah, so I've got that in the slide here. I'm going to break out the pointer. So it's the loan disbursement date, which is right here, which is the day you received the funds, which is not the day you were approved or told you were approved or told you have an E-Tran number through the SBA or through the bank. It's the day you receive the funds. Okay. The idea there being that you can't spend them if you have them, so your forgiveness period should start on that day.
Okay. Thanks.
But like I said before, that could fall, within payroll cycles, and that's why, in this last round of guidance, we heard this alternative payroll covered period. So it could be helpful for a lot of people. If you do a once-a-month payroll, you're not eligible for that because you could end up waiting almost a month to start it, and that's something the SBA didn't want to consider, I think.
Yeah.
So then the next question is, okay, how do my expenses fit in that period? Not everything is going to be clean, and there has been some specific guidance on this, and there are a few items that maybe are less clear. With regard to payroll and non-payroll, you're generally judged on a paid and incurred standard, meaning if the cost is paid for in cash with the PPP funds during your period, it's eligible for forgiveness. And if it's incurred, same thing. And the incurred standard is, say you didn't use that alternate period, your last payroll within the period started on July 1st, and then the last day of your covered period was July 10th, but you're not paying that payroll out till after July 10th in terms of the cash portion. You could still count that 10 days you incurred, even if it's not paid till after the period, as long as you pay it on kind of the next payroll date. What that means is that you have to pay it as it would come normally scheduled. You can't say, I paid them all this money during the 8-week period and then not pay it till the end of the year like a bonus. So those are kind of the 2 standards. There are a couple questions on that. One that I've received a lot in other webinars is, well, what happens more on the front end? What happens if I start my period at the second to last day of a previous payroll period and then pay out that full payroll? Does that count? Plus then kind of, a normal 8-week cycle? And the answer right now seems to be yes. Not totally sure on that. The SBA has said bonuses are allowed, but they haven't specifically said payrolls, that started in a previous period but end in the beginning part of the covered period, what that means. It seems like they'll generally be safe, but again, we don't have specific guidance. For the non-payroll costs, the SBA did actually give an exact example of skipped ahead a little bit. They gave an exact example of, if you actually have that happening where a previous period's like rent, you start your covered period on May 1st and your April rent is usually paid on May 5th. You can pay April. You can then pay May on June 5th, and then you can even pay June on July 5th, and those all would count. So you have a little more flexibility there on paid and incurred with non-payroll, at least explicitly defined by the SBA. So payroll costs eligible for forgiveness, because to get 100% forgiveness of your loan as the law stands now, you have to spend at least 75% of it on payroll costs. What that means also is that you can spend less than that on payroll costs. It just means you won't be eligible to get the whole thing forgiven. But what payroll costs means, there are two main components: cash and non-cash. And the cash portion is fairly simple. It's salary, wages earned via hourly wages, tips, commissions, paid leave, even severance pay. And then for owner employees, it's your payroll to yourself. And these are cash costs. These are limited by this $100,000 cap, which was a concept that you hopefully might be familiar with from when you applied for a PPP loan. It's kind of limited the amount you contribute towards your average monthly payroll, and that still holds as a cap for what you can pay an individual employee in cash compensation. The other kind of three things that go into that payroll cost are employer-paid health insurance and retirement contributions as well, and then employer-paid state and local taxes, things like state unemployment tax. What this is not is deductions and withholding that employees contribute to both healthcare and retirement. Excuse me. Then there's the other non-payroll costs, which can contribute towards forgiveness, but are limited at 25% of the overall forgiveness amount. These are mortgage payments, and by mortgage payments, we mean mortgage interest payments, meaning you own your building and you have mortgage interest due. You cannot prepay mortgage principal nor prepay future interest. Rent is another one, and this is again monthly rent, and you cannot prepay your rent. Utilities is one that I think confuses a lot of people, and not because it's a confusing concept, just because all we have here listed are these categories, and the SBA has not gone into any further detail, and there obviously could be a few questions on what exactly is included. Both these two types of costs go in to make up your overall forgiveness amount and your overall loan amount, the payroll and non-payroll. So this is an example calculation. Say you got a $100,000 loan, and you spent 80,000 of that on payroll in 8 weeks, and then you spent 18,000 of that on rent, 2,000 on various utilities. That would get you to $100,000. You spent the whole thing on those covered categories, and in that case, since you kind of went over the 75% threshold, 100% of your loan would be forgiven. This is where it gets a little more confusing. I think most people generally can understand, it's fairly intuitive. Okay, I have to spend most of this on payroll. I should try to spend it mostly on payroll. It's the Paycheck Protection Program. These are the other categories that can count. Where it gets complicated, and it's very complicated to do these calculations, is when you're trying to evaluate if you'll have your forgiveness amount potentially reduced by the concept of reducing headcount, which the SBA calls full-time equivalency, or the potential reduction based on you reducing the salary rate or hourly wage rate of employees. The way this works essentially in both cases is you're looking at where you are at the end of the covered period or before the safe harbor date of 6/30/2020 and comparing to a prior period. So for the full-time equivalency, you're looking at either the comparing to the beginning of 2020 or February to June 2019. And if you have less full-time equivalent employees at the end of this covered period or June 30th timing, then you will not get full forgiveness potentially. And kind of, if you had 10 in your reference period and then 8 in the current period, you'll receive 80% of the amount that you just calculated, as I showed on the previous slide. The reduction based on the salary and wage rates is a bit more complicated. There's a whole schedule in the application which goes through calculating this on an individual employee basis. And essentially, if you've kind of, the rule is if you reduce it, greater than 25%, you could, and not haven't recouped that rate or restored that, the original rate by 6/30, then you could potentially be penalized there too.
Hey, Justin, just one thing I want to jump in. To the whole audience, we're looking at your Q&A and stuff coming in, and I'm taking notes on it. So we're going to address a lot of these at the end once we get through these slides. So don't worry, we're going to address these.
Yeah, it's always tough when you're doing these to kind of live address them. And I think it's good to maybe give some food for thought, and then we'll circle back to these at the end for sure.
Yeah.
Okay, I'm going to breeze through these a little bit for now. One thing I want to cover is the concept of a safe harbor. It's just kind of a legal / financial term, which means if you do X action by this date, these punitive penalties, won't be applied to you. And essentially says, if you've reduced your headcount or reduced your wage rates and restore them at any point, before June 30th, and hold that level, you won't be penalized in terms of your forgiveness amount. So in terms of the actual forgiveness process, the application itself is available online. It's like I said before, it's somewhat confusing, to be honest. And there's this application and then this Schedule A concept, and they give an example worksheet as well, and some other borrower demographic information forms you can fill out optionally. You submit this package, which is kind of described there in the application, to the lender, not the SBA. They have 60 days from the receipt of that application to give you a response. In addition to the documents you submit to the lender, you're also required to hold all these backup documents in your records for 6 years. And the SBA reserves the right with the Office of the IG to request access to those files. In principle, we expect very few, or I personally, as an opinion, expect very few loans to be audited unless they are of the larger variety. And Secretary Mnuchin has previously cited $2 million as a threshold, where they may be more interested in auditing those above that number, which is very, very few people, relatively speaking. So documentation is another area which I think, was largely, was sometimes and often confusing during the application process. Different businesses use different payroll providers. Some of them don't use payroll providers at all. There's different levels of sophistication, from an LLC that employs 200 people to a sole proprietorship with a single person. And documentation is equally variable as the business and setups themselves. So this is basically copied verbatim from the SBA's application document and says, okay, this is what we're looking for. I've editorialized, with my Gusto example a little bit here, but essentially it's very similar type documents as what you use to get your loan. So if you were, someone that used a Gusto payroll report as the basis for your average monthly payroll, then Gusto in all likelihood will release a covered period calculator, and you can use that for a lot of your payroll. If you use something like an IRS Form 941, that may be a little difficult to get right at the end of your covered period, and maybe you'll have to wait till the end of the quarter and then file forgiveness, or you just file without it, right? I think those, even payroll in generally, is probably the easiest one of these. I think when you're talking about healthcare and retirement contributions, these are kind of whatever records you have from the providers of these services, maybe coupled with actual bank account payments, or if they do appear on a payroll register or even in your accounting general ledger. I mean, basically whatever you have that best and most, or best documents this at kind of an arm's length, meaning there is a third party showing this versus you just writing it in a spreadsheet and showing it. I think that is the best way to think about this documentation. And like I said, generally thinking about what you used on the application process can guide you on what you should use for the forgiveness process. Similar concept for these non-payroll documents, mortgage, rent, and utility. The latter two are going to largely be just the invoices you're going to have for each month, probably. The mortgage interest payments may be a little bit more complicated. But again, if you're in that situation, you probably have some sort of documentation. Again, this is copied directly from the application here, what I'm showing. So this is a good reference, and it does cover this, like I said, in that document if you've downloaded it. Now, we talked about the potential reductions, the full-time equivalency. This is kind of what's been cited, again, as examples. The one that gets a little dicey here is a question I've gotten in previous webinars is, what happens if I've laid off someone or furloughed an employee and I try to hire them back and they don't come back? And am I going to get penalized for that? And the answer is no, you aren't. There's, the second bullet here, there's 4 cases where you won't. But then the question, in documentation goes, well, what do I show to prove that someone turned down my offer? There hasn't been much there really in terms of guidance, but I think, any communication will hopefully suffice. These are some additional records that you're supposed to keep, but not submit. And like I said before, there are some detailed calculations that I think is kind of beyond the scope of this webinar. But any supporting schedules that you have when you went through your individual employee wage rates and things like that should be kept for a period of 6 years. So this is kind of the slides that we had prepared. I think, Duncan, now we can kind of go more into questions. I know we have a lot to cover, and what I'm going to do probably is I'm going to take these slides down, and if there's a specific need for me to reference any of the material, I'll bring it back up. Yeah. Otherwise, we can just turn this into a conversation.
Yeah, absolutely. So we have a wide range of questions, just so everyone listening knows what's going on. So we got a bunch of questions before the webinar, and then we've obviously received a lot of questions during the webinar. And what we're trying to do is put them sort of into buckets so that multiple questions can be answered in one. So Justin, let's start with there's a lot of people asking questions about calculations of full FTEs. And whether, if you have part-time employees, how do you count them versus full-times? What if you had an intern? Do they count? And then also as it relates to people that wouldn't accept job offers. So maybe we could spend a little time thinking about the calculation of that and just encapsulate as much information as we could for people.
Sure. This is definitely a common one, and I'll go into depth. So the way that it works is fundamentally the government or the SBA in this case is trying to make sure that that it protects paychecks, the Paycheck Protection Program. They want you to basically, if you've laid off people or furloughed people or anything like that, they want you to kind of bring those levels back up with this money. So what the provision says here is essentially evaluates your full-time equivalency in the covered period compared to one of two reference periods for a regular business. Seasonal businesses have a little more like flexibility in terms of what they can use for their period. I'm actually going to use the slides here because there is a relevant slide here that I think will kind of help with this. Okay. So the way this works is you compare to one of these two periods, like I said, and that is this period here, 2/15/19 to 6/30/19, or 1/1/20 to 2/29/20. The way you calculate it is by this full-time equivalency standard. So the way that is calculated is on a weekly hours basis. So if an employee, works 30 hours per week, then you divide that 30 by 40, round the total to the nearest tenth. In that case, you would get 0.75, right? And that's kind of how this is added up. You could do that on an individual basis and get, a lot of different fractional kind of amounts, right? And I guess in that case, it would be 0.8 because we're rounding to the nearest tenth. And you could kind of then add all those up, if you had part-time people working, different amounts, you would have different kind of answers for that. There's a simpler calculation though, which just says everybody who works full-time is a 1, everybody who works less than that is 0.5. And since you're using the calculation the same in both periods, it makes it simpler without changing the result, if that makes sense. Unless that you think that maybe there are some differences between individual employees, but we won't get into that. So the way you would do this is say, okay, if I had 8 full-time employees in this period from 1/1/20 to 2/29/20, and now I have 7 full-time employees and 2 part-time employees, you would then be fine from a forgiveness perspective, and you wouldn't be diminished in any way. If you had 10 full-time employees and now you have 20 part-time employees, and you use this simplified calculation, that would still be okay. You can kind of do some mixing and matching there, but suffice to say, what they're looking, or what the SBA is looking for here, is for you to maintain the same amount of work, meaning you can switch configuration of full-time, part-time, but when you do make that comparison, it has to be a one-to-one comparison. And if you ended up with, say, 9 full-time equivalents in the current period versus 10 in a previous period, then that's 9 divided by 10, you get 0.9, which they call this quotient. And what it means is that your forgiveness amount has 90% applied to it, meaning if you had a $100,000 loan and that was, you spent all of that even all on payroll, you would still only get 90% or $90,000 forgiven. I know that's slightly confusing, Duncan. It's hard to, honestly, it's hard to explain in a simple way, but it's basically just 2 periods being compared over one another.
I absolutely understand the difficulty. I mean, it's a factor in the whole application, right? There's these guidelines, but then there's the real world and all the different things that go on, and you're trying to sort of fit them into each other. So a few things that 2 other categories that we definitely need to address are, 1, sole proprietors. How do you pay yourself? So I want to get to that. We also want to address a big issue, which is this cost forgivable? So there's tons of questions about that. So we kind of want to bucket those. Why don't
I hit one more here too, just before we move on?
Yeah.
Just one more point. The one thing that I want to emphasize here is with these 2 different reference periods, you can pick the one that's most advantageous to you. The earlier period, if you've been hiring, growing your business, right? The earlier period may have a lower comparison number, meaning you could have had 6 employees in early 2019, gone up to 10 and be back to 6, but due to economic conditions, and you would still be fine by the forgiveness standard if you compare to the earlier period. Just wanted to kind of make that clear. You can choose, and it behooves you to do the one that's the best comparison. Sorry to interrupt.
No, it's a great point. And also to everyone, we're going to be sending around these slides, and also there'll be a recording of this published so that if you missed any of Justin's calculations, if your internet broke up, whatever, you'll be able to reference it later. So just so everyone knows that. All right, let's jump into sole proprietors. There's a lot of questions about how you can pay yourself if you're an owner and you're not a regular employee. I guess, I don't know if it would be easier for me to give you a very specific question to answer, or do you want to talk about that generally, and then I can ask some specific questions. What do you think's best, Justin?
I'll give a brief overview. So, if a lot of the way the application is written is more geared towards larger businesses, I think. You typically, it's not super focused on sole proprietors. There is one section which I'm going to find, I'm going to lean back on some slides here again because it helps me, stay on the exact message that the SBA has given us. So I think it's before this. Yep. So they have this line in there. It's around cash compensation. I'm going to use the pointer again. And it talks about owner employees. And so, when this program was structured, in the application process, you said, okay, if you are a sole proprietor, you used your IRS form 1040 Schedule C, you looked at your net income, and that was the basis by which you could apply, your average kind of monthly payroll was calculated off that, you got your loan amount from that, and now you're wondering, okay, how do I calculate what I can pay myself? The SBA specifically called this out here for sole props and said, these are self-employed individuals, owner employees, and the way that you can pay yourself is the minimum of 2 different numbers, or the lesser of 2 different numbers. If you made over $100,000 as a sole proprietor, I think that's line 31 on your 1040 Schedule C, you can then only pay yourself $15,385, or the 8-week equivalent of $100K a year. That's if you made over 100K in 2019. If you made under, then you can only pay yourself the 8-week equivalent of what you made in 2019. So if you essentially have, 80,000 on that line on your Schedule C, you can basically pay 80,000 divided by 52 times 8. And so what this, it's somewhat unfortunate a little bit here, and I've gotten a lot of questions on this in the past, is that, what if I was made under 100K and now have made over 100K in the last, in March and earlier in 2020, and my business is growing, or I was on track to make that, and now I can't pay myself the similar monthly amount, right? Because it's based off 2019. And that's something that, as written, is unfortunately the case. But generally, this is the guideline you should use for thinking about what you can pay yourself. I can go in, Duncan, do you think it makes sense? I can go into like the mechanics of how, I think we got a lot of questions on like documentation, or you want me to pause there?
One question about line 9 that we got before the webinar, which I think was a really good question, is kind of confusing, is in one section on the worksheet versus the actual numbers that you're reporting, it says that owner-employee compensation is not supposed to be counted in the full-time equivalent section. So a lot of people have a level of anxiety that when they applied, because it wasn't real clear what FTE meant, that they put 1 or 2 or whatever it was. But then when you do the calculation, your own income is not supposed to be counted in that. Now, from the way that I know that this sounds confusing, the way that I understand the worksheet from the forgiveness application is that it's not trying to discount that. It's just trying to make it so you don't duplicate the amounts in different sections. So to the people that are wondering about that, I think the intent was that you just don't want to count your compensation into 2 different sections. So they're bucketing employee compensation versus employee owner compensation separately.
That's correct.
I wanted to address that.
That's the way I read it too. It's confusing, but yeah, I think that's right.
One other thing, generally speaking, I just want to address one thing with you, Justin, is a lot of people point out a good question, which is they give you a loan of 2.5 times payroll, but you only have 8 weeks to spend it, which means almost by default, you have to spend money on things outside of payroll, right? Because otherwise, think about it. It was a very good question. So if you only have 8 weeks to spend 10 weeks worth of money, then you have to increase your payroll to get 100% of it forgiven. Does that or you have to spend X% on other costs that are eligible. Does that make sense to you?
It does. I think there's another way to think about it that maybe may make a little more sense potentially, which is, when the program was designed, that 2.5 times was, essentially meant to include, 2 months of payroll plus a bit extra. And there's a formula the SBA used that it's supposed to cover, this 25% of the whole amount through that kind of 0.5 turn they added on that. If you are sitting here thinking, okay, I can't spend 2.5 times my average payroll in 2 months, you don't have to get it forgiven. You could spend 75% of it or spend 80% of it and not spend the rest of it. You could get that 75 or 80% forgiven and return the rest. You don't have to take it.
Excellent point.
Like you can take it and then it would become debt. But if you don't want debt, you could spend 75% of it, which you should be able to spend in those 2 months, apply for forgiveness on that amount and pay the rest back. And it's just like you got a smaller loan and spend 100% on payroll. That's all.
Yeah, that's good advice, because there's a lot of small business owners that maybe have a digital business and work from home. And so then the rent and utility share of their business versus their house is a little bit murky. And so there's some anxiety on that particular point. One other question that we're getting a lot on sole proprietors is, what is actually the best way to pay yourself? Meaning mechanically, because if all your money's in the same account, then you don't transfer the money. So what is the best way in that case to prove that money that you're actually getting paid, that it should count against PPP? So, and obviously some people are resorting to opening separate accounts, but that's even difficult during COVID because banks aren't open. So what do you think is the best way to handle that?
Yeah, I mean, the cleanest way would probably be to open that second account, but like you said, not always easy. And also, if you've not done this and you're halfway through the covered period, it's not going to do you much good to track the first month's payroll potentially. Yeah. So it's kind of, if you're starting off like fresh, this was the day before you receive funds, and you use an online bank that you can spin up a separate account, put the money in there, and then pay yourself one account to the other. That's definitely a clean way to do it. I think if you're not in that scenario, which is going to be the case for a lot of people, then it's going to be, slightly difficult to establish like the standard I was trying to reference earlier, which is like this idea of a third party or arm's length documentation standard where, it's kind of like, if I give you a document that I created myself, it's less trustworthy than even if I exported it from a bank website. However, there's going to be so many people that fall into this bucket. I think thousands upon thousands of sole props that have these loans that didn't create a separate bank account, that there's going to need to be some sort of allowance for self-created records. Like, I've said before in other webinars that if you obviously have to report, your income and expenses on your taxes if you're a sole prop at the end of the year. So you should have some sort of ledger, whether that's in Excel or maybe you use QuickBooks or Xero or something like that. And you could then use like your interim financials to show, listen, this was my June, expenses and revenues, right? And this is my expense line for salary or something like that. Like maybe that's the best you could do. If you haven't done anything like that, then, I think it's very much going to be, I don't know. It's hard to say what it's going to be. It's going to be like, here's my bank statement. I received the money. I don't know. I don't know what to do.
Like write yourself a check to your own account. So then you have a check as a paper trail. I was thinking that might be a way to do that.
That's not a bad idea.
So I know it sounds preposterous, but this is PPP Forgiveness. So you got to do what you got to do. So that's just an idea.
It's a good idea. I mean, it's like anything you can have that shows the amount and is a document. Like it's, I think, maybe people will get more creative than even that potentially, but there hasn't been any specific guidance put out by the SBA, and it's all very much the documentation rules are very much more, or not rules, but guidelines are more for other types of businesses, unfortunately.
Okay. All right. Well, I hope that was helpful to everyone. I know that it's quite murky and everyone has a lot of anxiety about not wanting to look sketchy. And the smaller you are, the more difficult that is because you don't have all these extra services. So hopefully we gave some creative ideas for that. Let me scroll through the questions that we added in here. Let's see. Okay, why don't we do some eligible costs. There's a lot of questions about
eligible costs. I think that's a good place to go.
Okay. So I'm trying to organize the best way to ask these. Okay, let's start with a couple simple things about rent and utilities. And then we'll get into payroll stuff. Payroll's kind of its whole own world. But let's try and stick with what seems simple at the moment. So we've received a lot of questions about utilities and what counts as a utility. So obviously the immediate things that jump to mind are your electric bills, your gas bill, your internet bills, etc. But there are a lot of businesses that have like almost legally mandated costs of services that they have to subscribe to. That they're wondering if that can count as a rent or a utility payment. So for instance, businesses that have to lease copiers, copy machines, or any kind of those equipment, can those be counted as non-payroll but eligible expenses in one way or another? So equipment leasing, is that a utility, or is there a way, or is it a rent of some kind? So a lot of people are wondering how to categorize those kind of expenses because there's such a diversity of businesses. And again, we're trying to pigeonhole them into areas. So if you had any guidance on what a utility is, that'd be good.
So yeah, I think you covered a couple, points, not only utilities, but rent. I think, rent and leases, the way that's phrased, like if you're wondering about, lease payments on things that aren't just, rental leases, like a real estate lease, there's obviously vehicle leases. There's other types of leases if you're talking about leasing other equipment that you use for your business. The way it's phrased is lease payments for real or personal property. Real, I think the definition there would be, tangible, physical. So if this is you renting copiers that you have to use for your business because there's a regulation that mandates you have to keep certain records, that could potentially be included. Unfortunately, this is the only detail we really have on this, and most of the guidance that I've seen that or interpretation has been around real estate based stuff. Utilities is another one which this was at first just said as utilities, and then later on we got these categories listed. I think these are mostly self-explanatory, at least these first ones. I think transportation gets to be a little bit more murky about what that can mean. Telephone and internet access a little less so. I think if telephone is or internet, if you use these at your place of business, or if you are a sole proprietor and you deduct your home office on your taxes, for instance, this could also apply to that, the internet access in that home office or your personal telephone, depending on if this is an expense that you classify as a business expense. Transportation, you could say maybe that's vehicle leases or maybe that's some sort of other transportation. I think the other category that I'd seen just as a one-off, Duncan, was workers' comp that's mandated for certain industries like construction and other things like that. I think there's going to be a number of around the edges type costs that will fall into these buckets, but haven't specifically been called out. And I think the best way to go about thinking of those is, kind of put them like, here's my list of, I know these can be forgiven, and I want to optimize towards spending in those categories. And, here's a little sub list of things that probably are good, but I'm not sure, and document it all. But I wouldn't bank on things that aren't specifically called out right now. But you'll probably have some leeway to work with your bank on that, and guidance will probably get, more detailed as time goes on.
So just addressing the community, one thing I want to point out is what we're anticipating is realistically going to happen is, unfortunately, there's going to be a lot of businesses that are arbitrarily denied levels of forgiveness for certain expenses that might not make sense to them, and they're going to try and appeal those. So one thing we're going to do at COVID Loan Tracker is, starting in about a week or two, we're designing it. We're going to have a forgiveness survey where people upload, okay, I applied for this much PPP, I got this much PPP, this is what I submitted, and this is the forgiveness I got. And what we're going to try and do with that, and everyone listening probably knows we have an anecdote section with stories from individuals, which is we're going to try and help by pointing out ways that individuals got forgiveness and what they included. And then if people come to us and say, hey, I did this and it's exactly the same as this guy and he got it and I didn't, then we're going to try and provide information to help you when you contest that. So we're planning on giving a service to help you out, because we know that there's going to be a lot of vague things, and people are going to try and include things that are essential to their business, but maybe don't fit perfectly in these categories, and hopefully it gets approved. So anyway, we're mindful of that. So I just wanted to point that out.
Yeah, that'll be really helpful. I think this is a good chance to make a comment on the legislation that is also being considered right now, because I think it'll make the thinking about these categories of payroll and non-payroll a lot easier. And so last week, the House of Representatives passed the PPP Flexibility Act, which proposes to extend the 8-week period to 24 weeks. It brings down the 75% payroll threshold to 60%. It pushes out the 6/30 date to 12/31, among a few other things. So if you're thinking about, well, I guess one more quick update. This is in the Senate now. It's being discussed. It seems very likely to pass. Maybe this week, maybe next week, but my personal judgment is it's highly likely that this gets done, right? So whether it's 24 weeks or even 16 weeks at the end of the day, the likelihood is that this 8-week period gets extended. What that means is that if you're someone that's going, oh crap, like a question I addressed earlier, I can't spend 2.5 times average monthly payroll in 8 weeks, or I'm worried about including all these other expenses so I can get the whole loan forgiven. Well, if the period was doubled, then you could just spend probably the whole thing on payroll, right? I mean, because if you're talking about using an 8-week loan for 16 or 24 weeks, it's very likely that most businesses would be able to spend 100% of this on payroll over that amount of time. Does that make sense, Duncan?
Absolutely. I think everyone's hoping that this gets approved in closely aligned to what the house.
Yeah. So we'll table that for now, but I think it's worthwhile to note that that would make this a lot easier, and hopefully a lot of these like little expenses that people are relatively little I'm assuming could end up being moot because everything can just be applied. Payroll takes the whole thing. But anyway.
So everyone's hoping that.
Yeah.
So I think we got about 15 minutes left. So I think that's a good time frame to ask some cost eligibility questions regarding payroll and so forth. So first question is, let's talk about the 100K cap. Is the 100K cap, is that including cost extra to payroll, meaning healthcare, insurance, etc., or can you go above that as long as it's not actual pay to the worker, so benefits, etc.?
The 100K cap only applies to cash compensation. It does not apply to healthcare, retirement, or any state or local taxes paid, on behalf of employees for state unemployment. So you can basically spend $15,385 on any given employee during that current 8-week period, and everything else is kind of on top of that. So you could end up like getting forgiven, $15,385 for someone who has a salary over 100 plus another couple grand for your contribution to 401k and healthcare.
Yeah, so good. That's a clear answer to that question, which is nice. And then again, a question about hazard pay, because that's relevant for a lot of businesses as well. Can hazard pay be awarded so long above the regular salary level that someone was at, so long as it doesn't breach the 15,385 sort of 8-week cap? Is that acceptable? I think that
yes.
It is. I want to ask you. Yes.
Yeah. It was nice that in the last document we got from the SBA on the 22nd, they added in specific call outs for hazard pay and bonuses. And as long as you're still held, those are both cash comp, so they're both still held under that 15,385 cap. But I think hazard pay is relevant for a lot of people, and also I think bonuses are interesting. Again, I'm not a lawyer or a CPA here, and I'm not going to give legal advice or accounting advice here. But if you were, I've received questions in the past about what if I want to pay employees extra for pay they didn't receive before the period started. Theoretically, a bonus is allowed under the SBA guidelines, and it's a way that you could probably accomplish that. And I think as long as what you can't do though is say, I want to use the cost incurred standard and give everyone a bonus, but then pay the cash out at the end of the year. That's definitely not allowed. Okay.
All right. Thank you for answering that. Another interesting question, which some might have. So imagine that you got if you were lucky enough to get your PPP sort of early April or mid-April, so that so long as the end of your 8 weeks is prior to June 30th.
Yeah.
In that case, do you have to keep the payroll at the same level all the way through June 30th? Or is it only through the 8 weeks since you got your 56 days, basically? It's an interesting question, because if you're reporting well after June 30th, do you have to show that you maintained it through June 30th, or is it only for the 56 days?
So it's a fun one. The way that I interpret it is that they've treated the SBA is treating this 6/30 date like a bright line point in time, meaning regardless of whether your period ends before 6/30 or it ends after 6/30, you have to restore your wage rates or your FTEs on 6/29 essentially. It doesn't matter what happens after that. You don't have to maintain the average. Excuse me. Like you don't have to average the same amount of employees, because say, okay, an example where I furloughed a couple of people due to economic situation. I brought them back now, as I move towards that 6/30 deadline. I shouldn't be penalized when I'm trying to do the right thing with the money. I can't maintain that average the whole time because I just got the money and I didn't, rehire them on that exact day or something. So the way it works right now is you have this till 6:30 to essentially restore this level of either wages or FTEs. The one that I'm not totally sure of, and I think I know how it works, is that the 6:30 still applies even if your period ends after that. But I'd have to reread the rule on if it comes after that, can you use like the end of the 8 weeks? I think 6:30 applies no matter what. I'm fairly certain on that, but I'd recommend people reread that section specifically.
Okay. One question there's a little uncertainty about, I think it's easy to answer, is in the employment taxes eligibility, state and local is included, but federal unemployment is exempted. Is that correct?
Yes, you can only get forgiveness for one type of tax or two types of tax, state and local, and they both have to be paid by the employer. What that means is state income tax, which is deducted from the employee's pay, doesn't count. Neither does FUTA or federal unemployment tax. That doesn't count. It has to be like, I've paid my normal taxes, then the Colorado state unemployment insurance that then the employer has to pay into that fund. That is what is forgivable. And that was also what should have been included as part of your average monthly payroll when you applied for the loan. So it's very much an apples to apples on that basis. And this isn't every state, but it is a fair number of states. And it's usually, if you have a payroll company, it's usually, or pay this yourself, it's usually pretty clear what this is, but it doesn't include any federal taxes whatsoever and no income taxes, to be sure.
Okay. Another interesting question that someone asked on here. So can severance pay be included?
It can, somewhat counterintuitively, as this is the Paycheck Protection Program, but I'm going to share my screen for another quick second. So the way that it's specifically worded is for dismissal or separation paid or incurred during the covered period. One important point there is, if you fire someone for cause, for instance, and can't hire someone back, you will not be penalized for that on your FTE calculation. Fired for cause is illegitimate. So that is one important thing to note. If you do rehire them or rehire someone else, then all the better. But if you're forced to fire someone and can't rehire them, the SBA is deemed that you shouldn't be punished for that.
Okay, that's very good to know. One question: there's a lot of anxiety, mostly coming back to the fact that some workers make more from unemployment than from working. So there's been a lot of business owners in certain sectors where that's more relevant, who are having trouble getting the employees back. So there's a whole lot of anxiety that forgiveness is going to be reduced because of that. So what do you think is the best way to prove for your forgiveness application that you tried to rehire someone, but they denied?
So, yeah, obviously I think you left unsaid is that you wouldn't be penalized if you did try to hire them and someone doesn't take your offer due to unemployment. But yeah, there's no specific guidance on what it's going to take to prove that. I think, if you do something like, you have an offer letter of some kind, or you have some sort of communication, anything. I mean, I could see this being like, here's the offer letter and here's an email chain where that person, turned down the offer. That should be fine. I think, you might actually, end up okay in that respect if that's your issue. You just might not be able to spend as many funds, but if the period were to get lengthened, you'd be in an okay situation there.
Yeah.
But there's no real or no detailed guidance from the SBA. I think just like if you do make an offer and get someone, you need an answer from someone, try to get that in writing. Don't get that on the phone.
Yes.
I would say get it in writing in an email of some kind. If you have an offer letter or anything like that, save that in your files and kind of store that with the email communication. But I think I would, if you're making an offer, don't get the answer over the phone. And if you do, get it confirmed via email.
Yeah. So a lot of in this case, a lot of the employers may still be on good terms with their employees, even if they're not working anymore. So if it was over the phone and it was a couple weeks ago before you're aware of this, send it in an email, have them reply and you have a document, then save that as a PDF or whatever you're going to upload, so you have some documentation to rely on. Because obviously a lot of that hiring stuff's done on the phone, especially just an offer. So, and it's always harder to prove you didn't do something than something that you did.
Exactly.
Okay.
Exactly.
So yeah, that's some good questions. I'm just scrolling through here to see if there's something that we should wrap up with. One quick follow-up, I think, is
Sure.
a lot of people asking about this. Does any amount of hours count as 0.5% headcount? So there's a statement in the application of the forgiveness application about that, and it seems to me potentially to be a loophole. So I'm wanting to get some clarity for the audience, because we've gotten 3 or 4 questions to that effect.
Yes. I mean, the way I would read that, I'm just looking back at my slide here. It does. So the point being, if someone worked, it would otherwise have 0.1, but you're adding it as 0.5 here. That's kind of what you're saying.
Yeah, exactly. So if you're only employing someone, say 5 hours a week, so it'd be 12%. Are you allowed to just put that as 0.5? Because this can be very meaningful. That estimation can be very meaningful to some businesses about whether they reduced headcount or not. Especially businesses that use a lot of part-time employees, because they might have scaled down people's hours, but they kept a number of people. So if they're working less hours, maybe they're working less than 0.5, but if they're allowed to count them as 0.5, then they're within the employment that they could maintain their employment the same way. So I wanted to ask that because it's something that a lot of people are thinking about. And obviously, kind of murky.
Yeah, I do think there's a loophole there, right? Where you could say, like, in my period in the beginning part of the year, I had 5 employees and they each worked they each worked 10 hours a week, or 0.25. And now I have, I can count those each as 0.5, or I guess it would actually work the other way, where I actually had maybe 5 people working 30 hours a week, and now I have 5 people working 10 hours a week. I think that's more what we're talking about. I think that would theoretically be the same. Yeah, I could see that maybe getting clarified, but I think the whole point of introducing this 0.5 standard was to make it easier for people to calculate. And if you can get over on the government or a little bit here, then maybe they just don't care.
Yeah.
It does seem like somewhat of a loophole, but I think that, either you see it get kind of closed and they do away with that, or they just leave it as is because it's just around the edges, doesn't affect that many people.
Yeah, I agree. One last question, because I thought this was a good one, is what about prepaid expenses? So a lot of people have expenses that maybe at the beginning of the year, the beginning of the quarter, they prepay for, but then they don't incur the cost. And maybe it doesn't even get incurred in the next payment cycle right after PPP closes, which we know is how that's supposed to be treated, incurred costs. Is there any way to be able to amortize or use costs that you expected to be amortized into your PPP because they're actually part of your running costs?
So, when I think about what kind of expenses you would prepay normally, like, one that we do a lot at Fundera I deal with is, we prepay software, software as a service licenses all the time for the year, and then we amortize the cost over 12 months. Can't do that. Most of the things we do that with, at least in my experience, aren't in these categories. So when you think about what do you normally prepay, like typically you don't prepay utilities, and prepayments are generally
prepay rent.
Okay, so you explicitly cannot prepay those expenses. Let me just find the slide here.
But the question is, what if they were prepaid before COVID, meaning like at the beginning of the year? So I mean, it wasn't intentionally front loading, meaning it just happened the way that your normal course of business is going.
So that is an open question, right? Because the way they state it right now is that you can use the incurred standard if you pay it on the next due date. But if there is no next due date, which is what you said, I think at the beginning, is then what the heck do you do? The answer is I don't know. Unfortunately, the answer is like it meets the incurred standard, and I think if I was thinking about this logically, incurred would work if you've already paid for it. I think the whole point is that you don't incur for something that you pay much later, not for something you've already paid. But then again, I don't know how the SBA is going to rule on that one. I could definitely see some more guidance coming out on that. I think it's, somewhat unclear at this point. And I don't know, it's tough to say, like, when did you pay it? Did that cost go into your loan amount? I don't know. Maybe we'll see some guidance on that, but it's definitely a little murky, and would be kind of a shitty situation if you prepaid your rent at the end of the year.
Yeah, I agree. I just want to follow up. We're getting to the end of the time here. I just want to say thank you to everyone for attending, for all the participation. We did our best. I can say it's amazingly overwhelming to get all these questions coming in and trying to bucket them into useful answers, because we can't get everything. But I also want to say that if you send us questions at COVID Loan Tracker, we'll do our best to get back to you with answers. So I just wanted everyone to know that. And then we'll announce via the newsletter when we're launching the forgiveness survey, so we're tracking who's getting what, so then we can help everyone get the evidence that they need. And just special thanks to Justin and Fundera for hosting this. He's the expert, and I peppered him with your questions today. And then we're also planning to have another webinar on the 18th, which we will announce shortly, which will be focused on sort of post PPP stuff and what the funding landscape is going to look like. And it'll be less perfunctory and more of a discussion about the future. So thank you, Justin.
Yeah, thanks, Duncan. I enjoyed it. Hopefully it was helpful for everyone listening.